Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week after what was a volatile week last week with regards to quite a few different news events that drove volatility. First thing started with the Fed holding interest rates steady on Wednesday, signaling that there was a likelihood that September rate cut was not necessarily in the cards. That's obviously sent markets lower as a result of that. And then Thursday's hotter than expected inflation reading sort of flipped the markets in the opposite direction, where, or rather, solidified the fact that we were unlikely to see a rate cut in September. And then the weak jobs report on Friday really rattled investors. Not only was the job number itself for July quite weak. Instead of the 100,000 jobs we were expecting, we only came in around 74,000. But probably the bigger deal was the fact that the previous 2 months were being revised lower by nearly 250,000 jobs. And that really showed us that the job market that we had already started to see signs of slowdown over the last 4 months have really started to potentially accelerate a little bit. And it definitely puts concern into the strength of the US economy. And that was part of what drove the markets lower on Friday. Now, we entered this week with a bit of a bad news is sort of good news viewpoint. From the perspective of bad news means that the uh, the Fed will have a much higher likelihood of lowering interest rates, because the uptick in inflation was minimal, I would say, relative to what expectations were. But the job number were far worse than what investors were expecting. So when you kind of balance those two together, the weakness in the jobs report really solidifies the need to cut interest rates at the next September meeting. Arguably, you could even say that holding rates steady for July was potentially waiting a little bit too long. So markets, yesterday and even today have responded relatively positively to the fact that they are expecting the Fed to lower interest rates in September, seeing that as a way of supporting kind of the equity markets right now. So despite last week's volatility, we basically find ourselves in a position here again where we are in a buy the dip sort of opportunity. And the question for a lot of investors is that, are we going to see some further volatility ahead on the back of the weaker jobs number that we saw? Now, in my opinion, in the short run, I don't necessarily see that being a huge risk to the downside. We've seen earnings season so far report incredibly strong numbers. We're looking at about a close to 9% EPS growth on the S&P 500 with, about 80% of companies finish reporting already. So that's one of the strongest um, readings we've seen in a while with regards to expectations for corporate profits. We have, tax cuts that are likely going to provide some further support here for corporations over the next couple of quarters. It's seemingly the S&P 500 companies have navigated the tariffs relatively well as well. We haven't really seen any margin compression. So, all in all, if you look at kind of um, the growth that we continue to see tech stocks have on the back of the AI investments with Microsoft, Meta, and Alphabet in the previous couple of weeks reporting strong earnings and reiterating the investments, the capital expenditure investments that they plan on making towards AI infrastructure. Those are all investors are taking those incredibly well uh, and seeing some potential upsides from there. So I think at the moment the equity markets after last week's volatility are finding uh, a little bit of calm here this week, and I think that we'll likely see some further calm ahead, especially since we have a very light economic calendar this week, and we have about 29, 30 S&P 500 companies reporting this week, so relatively light across the board in terms of expectations or news events. So for those reasons, I think that this week would potentially be a relatively quiet week. If you look at the S&P 500, we've kind of pulled back to that support level here and bounced higher. We see the same on the Qs. We see the recent pullback here to a prior support that has now been kind of tested as support, and we're now bouncing off that support level and potentially moving higher here. We're seeing that on we're seeing that on small caps. We're seeing that on um, hmm, let's see. Not sure, I'm having some issues here. Uh, hmm, I apologize. I'm having some issues with my platform here. Let's switch over real quick. Um, So here's IWM small caps. As you can see, we pulled back here to that 210 level here. That's the prior support. We bounced off of it. Our expectation is to resume back to that 225 level and potentially continue moving higher. We're seeing that in small caps. We're seeing that in equal weight S&P 500 index, where we've pulled back here to this 180 support level here. This is a prior support. Bounced off these levels quite well. We're looking for that continuation back up to that 188 high and potentially continue moving higher from there. We also see high yield bonds continue to show some strength here as well. We're seeing strength across the board with regards to the bond market in terms of high yield credit. As you can see, last week didn't really respond to that volatility and actually made a new 52-week high here today. And arguably this is one area of the market that's potentially starting to get a little overheated, right? So we've seen a pretty substantial rally here in high yield corporate bonds. Basically not flinching at all with regards to credit risk, with regards to interest rate risk, any of that. Certainly if you look at TLT, if you look at the recent rally here in bonds on the back of the weaker economic activity that we're starting to see here. The question is whether we start to break out here above $88 here on TLT, and I think that we're starting to see a higher likelihood of that, especially if the Fed is going to lower interest rates a couple of times here between now and the end of the year. That's going to provide some support here for bonds in the short run. So, we're starting to enter this environment where equities, it's we're trying to thread a needle here, right? We're trying to see kind of corporate earnings continue to grow at a very relatively rapid rate, higher than expected. At the same time, we're seeing kind of employment and labor slow down. And the question is, again, still whether or not we can continue to see that soft landing um, that the Fed is trying to, thread the U.S. economy through, and it looks like we are at the moment still sort of in that direction unless the labor market deteriorates rapidly from here. That is always the biggest risk right now, and I think that's one that we have to monitor very closely, especially as if consumer spending and consumer demand starts to continue to wane, which we have seen that slow down quite a bit here in the first half of this year. If that continues, that is definitely going to create a bit of more of a drag here on equities. So we'll continue to monitor that and update you as far as how that goes. Now, in terms of looking at some of the trade ideas here for today, so the first one I want to take a look at here is Merck's. Merck, which is a pharmaceutical in the XLV ETF, which is the healthcare ETF. Recently, as you can see, this is a stock that has been underperforming for quite some time here. This was a $130 stock, traded all the way down to roughly $70, so nearly halved in value here over the past year, but started to show some signs of potentially bottoming here. So you have this potential bottom that recently formed, broke out here above that $78 level here, has now tested this level quite a few times here as support, and we're looking for that continuation higher here going forward. And Merck's trades at a very reasonable valuation, around 9 times forward earnings, even though it's expected to grow faster than the industry. So it's expected to grow EPS around 12% versus the industry is around 6%. Revenue growth around 4%, which is in line with the industry, but net margins of 26% is roughly double the industry. So it's far more profitable and it's expected to grow faster than its industry. So for those reasons, the fact that it trades at only 9 times forward earnings, which is about a 25% discount to the industry, that's really where I believe there's some significant upside potential here for Merck's. That's the first idea I want to share with you. Now, the second one I'll take a look at here is looks like I'm having some issues with my symbols here. Let's take a look at the next one, which is Pinterest. Pinterest, this is one that's been on our radar here for a few weeks now. Pinterest does report earnings here in just a couple of days. As you can see, it recently broke out here above the $35, $36 level. It also kind of broke out above 37 and retested that support and continuing to move higher from here. Pinterest arguably trades in line with the industry in terms of valuations. It's trading at around 21 times forward earnings, which is basically dead center with the rest of the industry. But if you look at growth expectations, Pinterest far exceeds the industry in terms of growth expectations. EPS growth of 23% is expected versus 12% for the industry. Revenue growth of about 14% versus 12% for the industry. And more importantly, free cash flow margins, approaching, 20%, it also exceeds the industry as well. So grows faster, is more profitable, yet it trades at a valuation that's effectively in line with the industry. And that's really where I think the upside potential here for Pinterest remains at the moment. The next one I want to take a look at here is Block. Block, as you can see, has been really kind of taken quite a bit of a rally here this year. We basically started looking at this when it broke out here above 60. When it broke out above 60, came back to retest this level of support, continue to make higher highs and higher lows. And now it recently pulled back here to the 72.5 gap level here. So it gapped higher, came all the way back to retest that, filled that gap, and now is potentially resuming that continuation higher here. Our upside target is $85. It basically fills in this gap here, right here. But we're looking for a further upside here once it fills that gap, into that $100 level here to the upside. So Block, trading at 16 times forward earnings is a deep discount to the industry, which is around 27 times forward earnings. And just like Pinterest, it's expected to grow faster. It's more profitable than the industry. And for those reasons, that's why I believe Block has, at the very least, should trade back at a multiple where the rest of the industry is trading at, as opposed to as opposed to trading at a deep discount to the industry at the moment, like it does right now. The next one I want to take a look at here is Alphabet. Alphabet, after what has been a strong earnings here in the last week, one, it broke out here above this 180 level. That was kind of a big move that we were looking for. And even after that breakout here, it popped higher on earnings, came back to retest 187.5 as support. And now we're basically on to trying to fill this gap here, which is around 202 or so. That would be getting us back to effectively what is the all-time highs for Alphabet. And if we can fill that gap and we can break out above that 205 level, this is really where you have a major double top that has been broken out here, and we're seeing some significant potential upside above that if we can get past those levels. And Alphabet, still trades at a discount to the industry, and it's one of the few names within kind of the AI space, compared to Meta, compared to Microsoft or Oracle. Alphabet is one of the few names in this particular space that's trading at under 20 times forward earnings. Most of those other names are trading closer to 30, 40, 45 times forward earnings in terms of valuations. So Alphabet, I think, still represents one of the most undervalued plays in the market here right now with regards to AI exposure, and arguably doing a pretty good job right now in terms of integrating AI into their services and trying to monetize that as, in my opinion, at the moment, better than anyone else on the street. There's a lot of ambitious projects out there. OpenAI, Anthropic, Meta, Microsoft, everyone is sort of competing in this particular space. And I think Alphabet right now is doing a pretty good job at showing investors that they're serious not only in spending money, but focusing on turning a profit with that investment. And I think that's really where I think Alphabet is likely going to excel, and I think represents one of the best values in this particular space right now. And the last one I'll leave you with on the bullish side here is Micron. Micron recently pulled back here to this 105 support level here. So it broke out. We looked at Micron when it first broke out above 85. That was the first breakout. It consolidated for a while and then just rallied all the way up to 130. Now it's pulled back to this 105 support level here. And I think for anyone who may have missed out on Micron, now is a great opportunity to start looking at adding some bullish exposure where the risk reward looks incredibly favorable. Micron trades at about 8.5 times forward earnings, which is cheap for semiconductors, but not particularly cheap for the memory space that it operates in. But more importantly, we saw Samsung last week, which is the largest supplier of high bandwidth memory chips to NVIDIA. We saw that Samsung missed earnings pretty heavily last week, and this is a result of the fact that they simply dropped the ball on production with regards to high bandwidth memory chips for NVIDIA. That we're actually seeing Micron is likely going to be taking some market share and stealing some market share away from Samsung, as a supplier to NVIDIA for their GPU chips. So from my perspective, I see Micron as a alternative way to invest in the build out of AI infrastructure outside of the more obvious ways to get exposure to that, which is buying stocks like NVIDIA, Taiwan Semiconductor, sorry, Oracle, Dell, these types of companies. These are kind of the more obvious ways to get exposure to the build out of AI infrastructure. But Micron, a key supplier to NVIDIA in terms of the memory that goes into those GPU chips, at the moment, I still think flies a little bit under the radar, trading at 8 times forward earnings, even though memory type companies generally trade at lower multiples. I still think that there's a fairly substantial amount of upside, and investors are not fully pricing in just how much market share Micron can capture away from Samsung, who is, the 800-pound gorilla in the room with regards to memory semiconductor chips. And it's very clear from Samsung's latest earnings report that Samsung is losing ground to someone, and that someone is likely Micron. And then now flipping over to the bearish side, a couple of names that I think are worth paying attention to. Cintas, the first one. This is they provide uniforms to job uniforms, and in a labor market that's starting to slow down here, that's really where I see some potential downside risks to this particular stock. Cintas trades at 45 times forward earnings, which is pretty sort of insane if you consider the fact that they supply uniforms. The industry um, average in terms of valuation is around 20 times forward earnings. So the fact that Cintas trades at 45 really reflects, a valuation that's incredibly rich. So for those reasons, I think the fact that, and the thing is that Cintas isn't expected to grow any faster than the industry. It is a little bit more profitable than the rest of its peers, but that's the only thing that it has going for it. So if you consider all of that information, Cintas trading at 45 times forward earnings just looks incredibly expensive. And the recent kind of breakout here, or attempt to break out to new all-time highs and the subsequent kind of decline, we see the relative underperformance of the stock basically since April, showing us this stock is underperforming the overall market. And that's why I think there's some further downside ahead for Cintas. Next, I want to take a look at here is CrowdStrike. CrowdStrike, as you can see here, as the S&P 500 is making new highs, CrowdStrike is actually making new relative lows. And this really speaks to the ridiculous valuation that CrowdStrike trades at. It trades at 127 times forward earnings, which it is by all means ridiculous, but you could sort of explain that away from the fact that CrowdStrike is not particularly profitable. So they have very low earnings, right? And obviously PE ratio, there's a denominator, and if the denominator is very small, it makes the whole ratio look very large. But if you look at other financial ratios from a valuation perspective, CrowdStrike trades at 26 times revenue, which is almost unheard of in terms of valuations, right? Even in the heyday of the pandemic, when there were stocks trading at just some of the most ridiculous valuations, like some of the Chinese EV stocks, lithium stocks, those kind of things, they were trading at 18, 20 times forward earnings. That was kind of the top. So the fact that CrowdStrike trades at 26 times revenue, sorry, when I said 26, I meant revenue, not earnings. It's just trading at valuations that are almost impossible to justify, even though it is in a very fast growing industry of cybersecurity, and arguably everyone needs more and more cybersecurity these days. CrowdStrike, who is not profitable, and growth has slowed down quite a bit here in the last couple of years to, what I would say reasonable levels. We're talking about EPS and revenue growth that's close to around 20%, right? So higher than the average S&P 500 stocks, but well below, some of the the AI-based stocks. So the fact that it trades at valuation that's well ahead of kind of a lot of AI-based stocks really leads me to believe that CrowdStrike as a as a provider is starting to show some cracks, and the relative performance here over the last month, I think, is showing. It basically has underperformed the S&P 500 by about 25% in just 1 month. So significant downside in 1 month in terms of relative performance. The next one to take a look at here is Tesla. Obviously, yesterday's news that Tesla approved a $24 billion pay package for Tesla was taken positively, but it doesn't take away from the fact the stock continues to trade at downwards, lower lows, lower highs. We're looking for that potential break below 300 here. Tesla, like CrowdStrike, trades at pretty ridiculous valuations at 160 times forward earnings, which is not only unheard of in sort of the car manufacturing space, it's nearly unheard of even within the tech space. And Tesla continues to try to position itself as a tech company rather than a car manufacturer. And even if you factor into, the blue sky business opportunities that they're kind of seeking with regards to robotaxi, with regards to robotics, with regards to automation, it's still hard to justify 160 times forward earnings, even with all of those ambitious projects that Tesla is working on. Not to mention it's trading at 11 times revenue, which, for a hardware company is just incredibly difficult to get to wrap your heads around, and that's why I continue to view Tesla in the short run from a valuation perspective relatively negatively, and maintain a bearish view here. And so far, that view has remained correct here over the last month. And the last one I'll leave you with again is Apple. We've talked about Apple here multiple times here in the last few months. Basically, this 215 level continues to get rejected. And even after last week's quote unquote good earnings, we continue to still see the stock sell off. And again, that reflects just the high valuation that the stock is trading at. That's difficult to wrap your heads around. 26 times forward earnings, still expensive in my opinion for the stock, even after last quarter's earnings, which surprised to the upside, but really only surprised to the upside because of tariffs. And I think that surprise is going to be relatively short-lived, and that the concerns that we have with Apple in terms of the slowdown we've seen in sales, in terms of just the internal chaos they would have with regard to their AI strategy, just the general outlook of what they see as the future in terms of the company, it is very much all chaotic and up in the air. And at this point, it just doesn't look particularly strong here at the moment. So I think there's some further downside with its valuation at 26 times forward earnings, when EPS and revenue growth is in the low single digits at this point. We're likely going to see some margin compression here over the next couple of quarters here as well. And that's really going to, in my opinion, knock down the valuation for Apple. So with that, that covers where I currently stand here in the broader markets, and hopefully this gives you some ideas to look for the week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.